At IBCanada Group, we are your complete and independent source on the infinite banking concept, serving Canadians from coast to coast.
As you know, we are infinite banking specialists, and many infinite banking policies are owned through corporations because we work often with business owners and real estate investors. So I have with me here today Mary Chow, who is a certified professional accountant, and Mike Sidhu, who is an expert and works not exclusively, but a lot with business owners. He's an expert in working with business owners. Mary works also extensively with business owners. So I myself work a lot with realtors, and we've been looking a lot at corporately owned life insurance as well. So I have some questions for them today. Maybe I'll start with Mary. Mary, what would you say would be the typical client that would look at purchasing an infinite banking policy or a life insurance policy corporately?
Well, there are some advantages of having a corporate owned policy. Like one of the main advantages is the potential savings in the overall premium cost. Life insurance premiums are generally not tax deductible. And many corporations are Canadian controlled private corporations, CCPC in short, and they enjoy significantly lower income tax rate on the active business income, range from 12% to 15% versus over 50% for top individual marginal tax rate. So this means that the total sum required to pay the premium, in other words, the gross earnings required to pay the net premium, is lower inside the corporation. And beside the premium cost savings, other reasons to own a policy corporately may be a need for key person insurance, funding for a shareholder buyout, or as a collateral for a bank loan.
Mike, maybe you could comment, are there any disadvantages to owning a policy corporately?
Well, I think that that's a huge loaded question, Kathleen. One of the big things is the use of the capital as a living benefit of these policies. And we have to understand that it is not a taxable event, depending on how you access the reserves that you're creating. And it also depends who. So there's a few moving parts. You know, for example, the death benefit of an insurance contract, because by its very nature has a death benefit, will go to the owner tax-free. That's the corporation. However, the living benefit side, the cash surrender value that builds up over time as you are able to design and structure a policy in the most efficient manner to put capital into that contract, is for the use and availability of the corporation. However, depending on the correct way, and if you're following, Mary as a CPA would be able to explain this very well. If you're following the rules, there are other ways that you can access the values that you have inside a corporate life insurance policy in Canada and still be able to have it as a shareholder access to those funds. There are a few rules that you must follow, but it is onside from the Income Tax Act. So I think it's important that this isn't some sleight of hand. Most people think, oh, well, if my corporation gets the use and liquidity of that money, what about me as a owner of that small Canadian corporation? This is all written within the Act and tested within tax court. So these are phenomenal benefits that, if designed, used, and structured properly, not only do corporate owners be able to use it within their corporation, but also personally as well, as long as it's set up within the context of the Act. It has to conform to the Act, and there are ways of doing that. So
we're not talking about aggressive use of bending tax laws or anything. This is all perfectly normal and covered by the Tax Act, correct?
I think that's a great point, Kathleen. Life insurance does benefit from a preferred status asset within the Income Tax Act, if for those who know their history, the very first Income Tax Act in Canada federally was 1917, the Temporary War Measures and Income Tax Act. But life insurance, specifically whole life insurance, had already had 70 years of precedence. And it continues to be an asset class that within the Act, because of its grandfathering status, still enjoys a very preferential treatment within the Act. So this is, yes, absolutely. This is not, we're not trying to bend the rules. We're not trying to be aggressive in, I know that CRA is cracking down on a lot of aggressive tax planning things, but this conforms within the Act ever since the Act was established in 1917. So,
in fact, it's one of the last remaining tax advantages that corporations can have since they started to limit spousal income splitting and things like that.
Yeah, TOSI rules were a big slap in the face to a lot of business owners who were conforming, or who they thought were conforming to the Act and doing things as their accountant had suggested, and that was all on board, all up above board. That was not seen as aggressive tax planning. But when you have a change in ideology at the top, you have a change in the way that small business owners are treated. Some would argue fairly, and some would argue unfairly.
So, Mike, one of the confusing parts I get with clients is, how is the policy structured? Who is the owner? Who is the beneficiary? Who is the life insured?
Yep. So you'll see a lot of questions from clients. I've seen also a lot of questions from advisors who don't know what they're doing in this arena. And unfortunately, the way that they're setting up these policies are not compliant within the Income Tax Act. So as an example, if you have a corporately owned life insurance contract, which means the small business owns it as a separate entity, owns the insurance contract. They are the owner. They are also typically the payer of the policy, which means, so now we've got two separate moving parts here. We've got an owner and we've got a payer, and the third party is the beneficiary. Now, this is very important, is there are some things that are able to flow out of a corporation with very minimal tax. And it goes through a notional account called the capital dividend account. And so what contributes to that being able to be distributed out to shareholders is, for example, this isn't everything, but the tax-free portion of a capital gain. That is able to be realized by a corporation. Well, there's half of it's taxable and half of it's not under the current inclusion rules of a capital gain. And the tax-free portion is able to flow out through the capital dividend account. Now, it is also true that the death benefit of a life insurance contract, and I'm not going to get into the formula, but there is a formula. Not all of the death benefit gets to be flown out unless it depends. Like any good CFP, we all know that the answer to every question a client asks us is, it depends. So there is a formula, a line formula, that determines the amount of the death benefit that gets to be paid out into the corporation tax-free. That's always a tax-free disbursement. But how much gets to be distributed to the remaining shareholders under the rules of that capital dividend account. And the older the policy has been in place, the longer that's been in place, the more likely 100% of that death benefit is going to go out through to the capital dividend account to the remaining shareholders on a tax-free basis. However, it's also important to know that it's very dependent. So when we say it depends, we really mean that it depends because of the Act and because of the rules and the calculation that goes through to calculate what is that tax-free disbursement through the capital dividend account. There is a line formula that we have to follow. And I think it's also important that we remember that if you're building a contract primarily a death benefit, that this is going to be structured a little bit differently than if we're doing it for an infinite banking type of concept, or that type of strategy where we're trying to accumulate more capital into that insurance contract. Well, it's going to look and feel a little bit different, and it's also going to follow the rules slightly differently when we think about the capital dividend account amount.
I want to go a little bit deeper on the disadvantages, because this question is, what is the disadvantages of the corporate-owned policy?
Right.
So first of all, the corporate-owned policy are exposed to creditor claims as they are just another asset of the corporation. So company valuation, the Canadian control private corporation, the CCPC status, and lifetime capital gains exemption are other potential issues. So depending on the type of the policy, increases in cash values of the policy affect corporation in three ways. So first, increase of policy value increases the share value of the corporation itself. Remember, policy is just another asset of the corporation, thus increasing taxable capital gain on the disposition of shares caused by one of the following: sale, transfer, or death of the shareholder. The second issue is, should policy cash value become very large, this could also impact the corporation's CCPC status, the Canadian control private corporation status. The rules require corporations to have 90% or more of the fair market value of the corporation's asset used in an active business to continue to enjoy preferred CCPC income tax rate. A life insurance policy enjoys tax shelter growth of internal values, but its cash value is considered a passive asset for the purposes of this test. And third issue is, life insurance policy that surpasses the 10% of corporate asset threshold may also disqualify the shareholder from using the lifetime capital gains exemption in respect of a disposition of the corporation shares. So again, of course, we have planning around this to mitigate this issue, but that will be for our future videos.
So Mary, that's a very detailed explanation. Do you advise them that the corporately owned insurance be held in an operating company, or would it be held in a holding company? How do you decide?
Yes, so policy can and sometimes should be owned in Opco, operating company. Examples are Keyman Insurance, corporate shareholder buyout, loan collateral, etc. Other considerations like preserving Canadian control private corporation rule, the CCPC, should be taken into account. Having said that, as mentioned, our corporate-owned life insurance policy does not provide overall creditor protection of the policy's cash value. So ideally, a life insurance policy with cash value should be held in a Holdco holding company to protect it from potential creditors of the operating company. So the CRA includes the policy cash surrender value to measure the value of a corporation when determining eligibility for the lifetime capital gains exemption purposes. So it may be useful to have the policy owned by a holding company rather than an operating company to avoid jeopardizing the operating company status as a qualifying small business corporation, and thus jeopardizing the CCPC preferred tax rate and lifetime capital gain exemption eligibility. So mind you, like the CCPC considerations are not relevant for holding companies as they do not enjoy the CCPC rates anyway. So overall should be Holdco in general.
Yeah, and I don't know about you, Mary, but I'm assuming that you would do a lot of this kind of planning, bringing in other professionals in order to purify those corporations.
Definitely.
Now, for a lot of clients that are watching this, if you're a client, you don't really need to know all the details, and that's a lot of the heavy lifting that your CPA, your legal representative, and your financial advisor, who is either has some sort of designation in an estate planning capacity, maybe they've got their CFP or CLU or TEP designation, or maybe they are themselves a CPA. They'll be doing a lot of the heavy lifting and technical work, but just know that, again, the best answer is it depends. Right. And there's a lot of small business owners that will never sell they're a corporation, they're just going to wind up those corporations. And the outcome of those particular holdings may be slightly different. Excuse me, than somebody who has a growing concern business that they are planning to sell for a share sale, and therefore try and qualify for the lifetime capital gains exemption amount. So there are either way you look at it, it doesn't matter what your plan is. The key is working with a team of advisors that can move you forward in that proper wealth transfer plan.
But the point is, don't think it's because the premium is cheaper in the corporation. Then no, it's not that. It's more than that. So I mean, the purpose is to make sure that whoever watching that realize that it's not just because of a cheap insurance inside the corporation. There's more than that. But
speaking of that, Mary, is the premium for the insurance tax deductible for the corporation?
Well, generally, no. Life insurance premiums are not tax deductible. The only time portion of the premium is tax deductible is when a policy is required to be assigned as a collateral for a loan. In that case, lower of premium or net cost of pure insurance and CPI for short for the year is deductible for income tax purposes. But again, it's a lot of detail. But in short, no.
Okay, that's good to know. Mike, when you work with business owners, what would you say would be some of the top strategic uses that business owners would use the cash value in a policy for?
Yeah, that's a great question, Kathleen. There's multiple uses. As Nelson would say, the use of our capital is unlimited only by our imagination. And so therefore, what are the business reasons or not even non-business reasons that a business owner may decide to use those cash values of that policy? Maybe they're going to pay themselves a special dividend, a special taxable dividend. Remember, we're talking about a policy that's both owned, paid for, and beneficiaried by the company. So to take that money out of the policy, depending on how you take it out, or how you leverage that out, you're not going to pay tax inside the company. But once you break that corporate veil and you now start using those monies personally, well, that could be and is likely a taxable disposition. So maybe you're going to want to use it in your own personal name. Maybe you're going to want to use it to expand your company, pay for some expenses in your corporation. Maybe you're going to do a loan swap. Maybe potentially instead of doing a new loan for a big truck that you need, maybe you have enough capital inside your insurance policy to now be able to facilitate that truck loan internally. Rather than going to a third-party lender, you can borrow that money from yourself, pay yourself back your own interest if you're taking it as a policy loan. So there's many, many different ways that a business owner may decide to use the capital. And it's a big decision, right? There's a lot of things that you're going to have to think about. Number one, is this a taxable disposition or not taxable disposition? What is the use? Am I going to be able to potentially give rise to a interest deduction on the loan? How do I structure that loan? Who do I structure that loan with? Do I do it with myself or a bank? Am I going to take that money out personally, or am I going to use it in the corporation? There are many, many different ways that should be it should be a facilitated process. In my opinion, come back to the person that helped you design, structure, and implement this policy, because they have been trained through the Authorized Infinite Banking Practitioner Program on the best use of should you be now using, and there's a lot of people out there that can help you set up a policy, but not a lot of people that can actually help you use the policy. And that's really important. You want to make sure that you're getting the right information to come to the right conclusion on the best use of your capital. And it is your capital.
Yeah. So can I?
I was going to ask you, Mary, do you have anything else to add?
So let me elaborate a little bit more. There are multiple ways to assess the value of a corporate life insurance policy while the insurer is alive. The most popular option is to use the policy as collateral for a bank loan. This way, there's no tax triggered, and generally the interest rates are reasonable, around prime plus 1 or 2%. So this structure does require financial underwriting. So this might not work for every company. But if the corporation uses the loan to reinvest in the business itself or another business or investment, the interest becomes tax deductible. So another way is for the shareholder, as Mike said, to use the corporate policy as collateral for a personal loan. So in such scenarios, it is common for the corporation to charge the shareholder a guarantee fee to counter shareholder benefit issues for personal use of corporate asset. So an alternative to a bank loan is a policy loan directly from the insurance company itself, although the interest rate may be higher than bank loans. But please note that the policy loan does become taxable when the amount of the loan is greater than the adjusted cost base.
Mary, I often get asked the question, so business owners, they like the fact that they can shelter their money, safe store of money within the corporation, but they want to know how they can access that money out tax-free. And is there some sort of utopian way that that's possible or no?
Yes, there are generally 3 options to access the cash surrender value. The first one is partial or full withdrawal of funds directly from the cash value. The second is policy loan against the cash value from the insurer. The third one, that way it's the collateral assignment of the policy to secure a loan. The first 2 strategies could be taxable. However, collateral assignment of the policy to secure a bank loan is not considered a disposition and will not affect the policy's ability to grow on a tax-deferred basis. The bank loan can be structured in different ways, including no repayment until death, enabling more possible solutions for the business owner. Even while the loan is outstanding, the policy continues to grow on a tax-deferred basis, which could produce a higher return than the interest rate on the loan. For these reasons, the most efficient manner to access cash values usually is to collaterally assign the policy to secure a loan.
Okay. And what happens, I sort of always am thinking forward as to what might be some of the issues if the business were to be sold. So let's assume, for instance, that there's a company that makes widgets and they own the policy in the Holdco. When they sell the corporation, Mary, what would happen to that life insurance policy?
Well, if the company is sold, policy is treated, as I said, as just another asset of the corporation. It forms part of the sale, like all other assets and going concern of the business. So policy can be moved out of the corporation prior to the sale, but we need to be very careful. Change of the ownership of the policy is a disposition for income tax purposes. Further complications happen if policy is to be transferred to a shareholder of the corporation in a non-arm's length transaction, especially for non-arm's length transfer for no consideration. There is no payment by the individual acquiring the policy will result in transaction being treated as a taxable shareholder benefit, resulting basically in a double taxation. So usually that's what happens, when you try to liquidate the company. There will be tax consequences.
We would consider a double taxation to be a negative.
Yeah, so
that would only happen if they own the insurance in the operating company, correct?
If there is the only,
if they own the insurance in the Holdco, would that still happen?
So what do you want to do? You want to transfer out?
If they sold the operating company and they kept the Holdco, that would not have the double taxation, or am I incorrect?
Cap it, it's different way. Right now you're saying sold it, right? If I say you cap it, the best way is don't sell the company. Don't sell it. Just keep the Holdco forever. That's the best treatment. Shelter it forever. That's the best.
Right.
Sell the Opco, keep the Holdco.
Correct.
If possible.
Okay.
Yeah. If possible, of course, things might not be possible down the road, but plan with the professionals, to find, because again, what happened down the road, the tax law might change. Anyway, it doesn't matter at this point. We can talk about all we want, but things will change down the road.
Mike, are you concerned about any changes that might happen to tax laws with respect to corporately owned insurance?
Well, I can't I can't say that for certain, to Mary's point, that things won't change. But here's where it gives me a bit of confidence that things won't. The couple of reasons. Number one is the precedence. Life insurance enjoys that 70 years grandfathering prior to the act. If you take a look at the different types of insurance, for example, a universal life insurance, which came into force in Canada in the early 80s, those have been changed and switched. And some of the underlying rules have been changed for all insurance policies. But here's what we know is that life insurance capital, which means the money that is sitting inside a life insurance contract, is considered tier 1 capital. When you think about bank reserves, those are tier 1 capital assets. Mm-hmm. And a lot of banks own whole life insurance and own capital on those policies in order to help trigger their reserve requirements. So fundamentally, within the fabric of the Canadian economy, life insurance capital forms a lot of this underlying foundation of the Canadian financial system. So if they were to change the nature of how these assets are taxed, or to make wholesale changes to the act in order to change those things, well, they're messing with the banking system as a whole. So we're not really too concerned that they're going to do that. Number one, banks are a very powerful lobby in the government. And number two, it's just too much change to the fabric of how money flows in and out of both the government's hands to private ownership hands. And these transactions are used a lot of times with these whole life insurance contracts at the foundation of these transactions. So there is some protection. It's not guaranteed protection. I think it was, I can't remember who it was. Maybe it was Nelson Nash who said, if you think the problems that government create, just wait until you see their solutions. So there is a foundation and precedent setting, both from tax court and from the way that the Canadian economy works at its very core.
Okay, Mike, can you talk a little bit or expand a little bit more on the infinite banking concept with respect to the flexibility? I know when I talk to let's say real estate investors, they might have the money now to be funding 25,000, 50,000 into a policy, but the ongoing commitment of 50,000, when they're 65 is scary to them. Can you talk a little bit about how that might work with business owners or real estate investors in terms of flexibility?
Yeah. So if you look in Nelson's book, Becoming Your Own Banker, he does explain, and the page is escaping me right now, but he does talk about how the shorter the premium duration, which means how long you're going to pay for that base premium, and I'm going to talk in both of terms, the base premium and the cash top up within the limits of the Income Tax Act. I want you to think about it as being two separate line items. So the base premium really should be as shorter as duration as possible. Most business owners, most real estate investors, most owners of a privately held corporation in Canada usually pick a 20-year period premium duration. And basically what that means is that they're only going to pay a certain amount for a certain period of time, which gives them the confidence to say, well, I'm not going to run out of, I don't need to keep paying this for 30, 40 years. Now, the extra top up amount, you want to make sure that you're designing the contract for advisors out there. You want to make sure that you're designing the contract for the maximum duration. You want to try and get as much capital into that as possible. The way that I look at it from a business owner's perspective is it's really one of the only things that you can put your money into a tax sheltered vehicle inside your corporation. It's almost kind of like a TFSA, if you will. from a corporate standpoint, because you can't put a TFSA inside a corporation, but you can
Great
kind of
analogy.
replicate. Yeah, you can kind of replicate that using a life insurance contract. So again, minimum period on the duration. I don't find anything less than, for example, if you're going to try and stuff it in 4 or 5 years, I mean, you can try and do that, but your duration is always going to be set based on the base contract. And then how much extra can you put in there? And does the dividends, the more you put in, the better it gets, right? So if you've got, say, $2 or $3 million worth of cash that's accumulating a dividend, well, you can use the dividend to pay for the premium. Let's just say, for example, that, we're got a huge setback. We had 5 really great years, and now we're going through a little bit of lean times. Well, why not use the cash surrender value to facilitate future payments, future premiums? Maybe you're getting a dividend on that cash value. And while it remains inside the policy, it is we call it a dividend, but it's not really a dividend for tax purpose. Like, it's not a Canadian dividend. It is an interest payment, but while it's inside that policy, as long as you're not taking it out of that policy, there's no tax attribution to that dividend. Unless, of course, to Mary's point, you're starting to lose your CCPC designation, your special status. So these are some of the things that, and this is why, in my opinion, I think that it really pays to work with an advisor that works with corporate policies and works with corporate infinite banking in Canada, because there's a ton of rules that client is going to need to have their hands held through that process. And quite often, I speak for myself, I'm sure Mary can attest to this as well, we end up doing a lot of heavy lifting with the client's tax professionals, because the unfortunate part about the CPA course material is that it's not very in depth in terms of how life insurance is regarded within the CPA designation texts. There is some reference to it, but there's not a lot of disposition. You need to bring in an insurance professional who has the kind of acumen and experience to be able to lead that tax professional through some of the nuances of life insurance policy in Canada.
Yeah, it sounds like you're building these policies with a ton of flexibility. And it also sounds like you're really helping the business owners, accountants, because it has a lot of nuances, and it's not a specialty that a lot of accountants have. Not everybody is like Mary and is a CA and is insurance licensed, right? And yourself, you work with so many business owners, you probably should be a CA when it comes to these things. You're definitely.
You know what's really interesting, Kathleen, is
I said he used to be a lawyer.
Okay.
Yeah.
I think what's really cool is that once an accountant starts understanding the power, versatility, flexibility, and control that a client can get out of a properly designed whole life insurance policy, with all the nuances that are built on, whether that's a term rider or premium duration. Once an accountant gets it, I have actually, my experience has been a lot of referrals from accounting firms that I work with in Vancouver, because they're like, oh, can I do this? Yes. Because what they do is they start implementing it into their life. They start understanding and recognizing, wow, this actually works, and this can work for me in this way. This is just a tool. It's a tool. It's a financial vehicle that helps you achieve your goals faster, because in my most favorite part of this is the idea that you're sheltering against the headwind of tax. If you can put your money in an environment that compounds faster without having tax, tax it,
Yeah.
then you're going to do a lot better over the long run.
So, Mary, let's assume there's business owners that are watching this video and they're saying to themselves, is this for me? Can you describe what type of business owner, or what would be their personal situation in their business situation, that it would make sense for them to reach out to yourself or to Mike or to me, or an infinite banking practitioner, what is the typical situation where it would make sense for them, where there'll be a lot of advantages to this within their business?
Yes. So again, business owner, definitely they have advantage of either do a corporate policy within a corporation or personal owned or corporate owned. So they do have that advantage. So really depends on the situation, because I will always ask them, where's the money coming from? So that is basically the first part to find out, should it be corporate owned or personally owned? Because it's really based on individual situation. And again, it also depends on the needs and goals. IBC policy is a whole life policy, but recommendation to implement the IBC strategy and to fund it corporately depends really on their own situation and where the income is mainly generated at. So, but one thing to your point, just now at the beginning, Mike was talking about, Kathleen was asking about the death benefit tax-free or not. I want to elaborate that a little bit further. We know that it's tax-free, but the question should be, is the benefit tax-free to the corporations, or is that benefit tax-free to the shareholders? That I think I want to elaborate a little bit more. The death benefit is tax-free to the corporation, but the next step we need to know is what the adjusted cost base of the policy is at the time of death. So in its simplest explanation, adjusted cost base of a policy is, again, sum of all premiums minus the cumulative net cost of period insurance. This calculation, you can always find it from the insurance company. But if at the time of death, the adjusted cost base of the policy is zero, the entire death benefit is credited to the capital dividend account, again, CDA in short. But if at the time of death, ACB still has a positive balance, portion of the proceeds equal to the adjusted cost base, it's paid into retained earnings of the corporation and the balance, and then credited to the CDA account. So as long as the corporation has a CDA balance, it's been able to pay a tax-free capital dividend to its Canadian resident shareholders. And depending on the deceased shareholders' estate plan, the shareholders could include the estate, the spouse, or the heir. So any portion of the death benefit that exceeds the CDA credit can be paid out to the corporation as a taxable dividend in that case.
Yeah. Can I actually add something to that as well, Mary? It's very important that people understand that by putting in a life insurance policy in place inside a corporation, and by having large cash values inside that corporation, it's not that we're creating a problem. The problem already exists. What we're trying to do is we're trying to solve for getting as much tax-free dollars through that corporate dividend or capital dividend account rather, through to the remaining shareholders, whether the shareholders, the deceased shareholder's child or children or beneficiaries. You've got the money in the corporation anyway. By putting it in the policy, you're getting an additional benefit of using it as a CDA. Now, the adjusted cost basis of a policy, I want you to think about that as being a forced depreciation almost on that. And so you're depreciating that tax value down to zero, but it works in reverse. It's not that you have to recapture those dollars. Usually when you depreciate, as a real estate investor, Kathleen, you'll understand that when you sell a property, that depreciation has to be recaptured as income, plus the growth has to be, there's a capital gain on that. Well, we're eliminating all those things because it is a life insurance contract that has special precedents within the Income Tax Act that gives corporate owners additional benefits. So an adjusted cost basis of a policy is a moving target, to Mary's point, and it's very easy to get those numbers from the insurance company itself.
Okay. So, great. So let me continue to elaborate this CDA, because this is a very, very great advantage to corporate owner to know about this capital dividend account. Again, as Mike mentioned, it is a notional special corporate tax account that tracks tax-free surpluses accumulated inside the corporation. When a company generates a capital gain from the sale or disposal of a capital asset, 50% of the gain is subject to capital gain tax, the non-taxable portion of the total gain realized by the company is credited to this capital dividend account, the CDA. And the only asset that enjoys this preferential tax treatment with inclusion rate of 100% versus 50% is life insurance. Proceeds of life insurance less the policy adjusted cost base are credited to the corporation's CDA and can be distributed to shareholders or to the estate. So therefore, this CDA account provides a tax efficient, it's a tax efficient method of moving money out of the corporation by issuing tax-free capital dividends to the estate or intended shareholders. So as long as there's a CDA balance, it's able to pay a tax-free capital dividends to its Canadian resident shareholders. Good stuff.
And actually, to your question earlier, Kathleen, about how does a corporate owner use these proceeds personally during their lifetime? And if they were to set up a personal credit line or facility using the collateral value of that insurance company,
right,
or the insurance policy, well, now you start layering on a lot of these other benefits. So for example, let's just say that you had a business that had a large cash value in that policy. The business owner took a 50% loan to value. Maybe you've got $2 million worth of cash value in the life insurance contract. You set up $1 million line of credit, and there's no payments because they're using it as a retirement income, and that would be like a corporate insured retirement strategy. On their death, well, how do we pay this out? Well, enter in the CDA credit, which allows for a large amount of that death benefit to flow through
the capital dividend account tax-free.
Yeah, so the bank will take a collateral assignment against the death benefit in order to provide the payout mechanism, so they're not stuck on the hook for the money that they've already lent out to that corporate owner. So yeah, when you start layering on all the benefits, no headwind of tax, the tax preferred disbursement, the use and ability to maintain the control and liquidity of that money during your lifetime and during your retirement. There's so many benefits to owning a life insurance contract inside your corporation.
Yeah, but one last thing about the CDA is in order to flow the money out of the corporation, a capital dividend must be declared by the directors of the corporation and paid to the shareholders. So a resolution of a directors,
right, in the notes, in the minutes,
also recorded in the minutes, and also election must also be filed with the CRA. So there's a bit of step and procedure that needs to follow as well.
Yeah.
Mm-hmm.
So I'm hearing, just to summarize what we've covered so far, it's been complex. It's been detailed. It's been something that I think business owners need to hear, but I also think it's something that their accountants need to hear and help them with. I think this video would be something excellent for business owners to forward to their accountants. I think that if there's a business owner sitting here today and he says, should I reach out? What is your typical client profile, Mike, of a business owner? Do they have, like I'm hearing, for instance, that they have retained earnings that they're not deploying. I'm hearing if they want to have an efficient retirement income. I'm hearing if they want to preserve capital for their future. What else is there, or have I hit the nail on the head there, or what? How would you expand that?
Yeah, I think the number one thing for business owners is to make what typically happens, Kathleen, is that business owners make the mistake of thinking that it's for somebody else. They think, I don't have enough money, I don't have enough retained earnings, I don't have enough capital, I don't know what I'm doing, so therefore it must not be for me. Let me be very, very clear. Infinite banking is not a one size fits all. Infinite banking, especially in a corporate situation, is as flexibly designed as there are the number of people who own a small business in Canada. It is tailored to the individual. It's tailored if they are going to own it personally or corporately. It's tailored to their situation so that you can maximize the benefits, as small or large as they may be in your situation. It's kind of like estate planning. You know, people think, oh, well, I don't have any beneficiaries, so therefore I don't need an estate plan. Well, the minute you decide that you don't have a plan, you accept automatically that the government has one for you. And so that's never a good thing, especially as most business owners in Canada, in my experience, most business owners that want to do this type of planning, it's because they're frustrated. They have some level of frustration with the amount of tax they're paying. They know that there's something else out there that they're not quite able to put their finger on in order to enjoy the benefits that are really designed for, like if you even go back to Robert Kiyosaki and Rich Dad, Poor Dad, you use corporations in order to enact special things that you cannot enact as an employee. So for business owners, the number one thing is get more information, go consult with somebody who is an authorized IBC practitioner that has the experience and acumen to be able to lead you through the pros, cons, benefits, and drawbacks of putting this in your business life so that you can make a great decision on whether or not and how you can put this into your corporate environment. I really think that once most people start digging in, they really realize that this isn't some pie in the sky for the ultra wealthy people in Canada. It is anybody can do this. You know, I've got clients that are putting in $100 a month, and I've got clients that are putting in $300,000-$400,000 a year into their policies. So there's a range of possibilities that you can use infinite banking for. So don't think that it's just.
This is great. I mean, what I'm hearing is that we can help everybody because these policies are so flexible that we can, you know, delve into their personal circumstances and help anybody. Business owners, I think they get it because they get the tax advantages, they get the dividend income versus employee income, they get the write-offs. And so they'll really embrace all of that the infinite banking policy can do for them personally by owning it through a Holdco. So this is great. Is there anything I haven't touched on that Neri, you might want to expand on, or anything I've missed that you want to say before we close it up?
Mike already wrapped up a lot of great points, so we're good.
Mike, anything else?
Just again, I can't emphasize enough that you have to be willing to let go of the preconceived notions that you may have. Like, how did you come to your belief system?
Right.
And a lot of people that, oh, I don't believe in insurance. Well, that's okay because it's not a religion. So we don't really need to worry about that. What we need to do is your mind works best like when it works like a parachute. It works when it's open. Mm-hmm. And as long as you may get down into the nitty gritty of how infinite banking can work for you, and you may still decide that it's not for you, but opening your mind in order to have a good, solid look, maybe at what you're missing with the infinite banking concept. And there are lots of people out there in Canada who are authorized practitioners. And that's also very, very, very crucial, is that you should not be setting up an infinite banking type of policy unless they are an authorized practitioner. The people that go through that program know exactly why, how, what, where, and who to be able to properly design this contract in your personal life. So that's a major key right there.
Right.
Yes. So to your point, Mike, a lot of people know what life insurance is, but they don't know what life insurance does. Let us show you how.
100%.
Right. I see this all the time too, personally, that personal owned insurance policies, people make the mistake of thinking that it only benefits those when they pass away, it benefits others, but it's all about what it can do for you. And corporately owned insurance is just expanding on that and what it can do for you and your corporation. So with that, I'll just conclude, and I encourage you to reach out to an infinite banking practitioner, because as Mike said, we can help everybody. So business owners should really look into this with an open mind, and I think they'll be pleasantly pleased. So thank you again for your time, and like our video and follow and subscribe. And there's lots of additional great content out there for you.
IBCanada Group, your independent authority for information on the infinite banking concept.